So capital structure theories, what these theories are all about, why this theory has been propounded. First of all, there is a traditional theory which says capital structure is relevant. What traditional theory says is capital structure is relevant, to increase, like relevant for a business, for a particular business. Okay, why capital structure is relevant? If a company is having a combination, a proper combination of debt and equity, okay, that is going to increase the value of the firm. Okay, they should not have very high proportion of debt, neither have very high proportion of equity. They should have a balanced structure. Very high debt is also not good, very high equity is also not good. We have already discussed right now. So they say capital structure is relevant for a business. Okay, and the counter against this is, now why capital structure is relevant. See, if there is a optimal capital structure, the cost is balanced, the cost is not very high. If the cost is not very high, that may increase the value of the firm. But to this, Modigliani and Miller, Merton Miller, Nobel Prize winners, okay, in 1958, they came out with their theory that they say the capital structure is not relevant for a company. Capital structure has nothing to do with has nothing to do with any kind of profitability. Okay, here we will be seeing that. So, the operating earnings are unaffected by financing decisions. The total value of debt and equity will be unaffected by proportions of debt and equity in a firm's capital structure. So they say that capital structure is irrelevant. Whatever capital structure you may have, it doesn't matter. The value of the firm will only increase with its capacity to take higher risk, okay, and increase its operating income, okay, generate higher operating income. So they say capital structure has nothing to do with value of the firm. The value of the firm will increase with higher operating income and firms risk taking capabilities, and to increase the operating income. Okay, just a second. So traditional theory is very clear. They say that capital structure is relevant for a company. They say the optimal capital structure is that which can minimize the cost, the WACC or cost, and maximize the value of the firm. Okay, so that's what they say. Optimal capital structure minimizes the WACC and that maximizes the value of the firm. That is the traditional theory says. Says this is a useless stuff. Okay, they say that capital structure is irrelevant. Okay, and capital structure has nothing to do with the value of the firm. The value of the firm does not depend upon any optimal capital structure, that is ideal mix of debt and equity, but the value of the firm will only increase. Okay, with what I said, the business risk, what the company, the risk taking abilities of the company, and the higher operating income if they generate, that will increase the value of the firm. Okay, but see, has given all this to give backup to this statement. Has certain assumptions, so we will look into those assumptions right now. Okay, and like yeah, so we will just look into the assumptions properly. Okay, and we will try to kind of summarize what the wants to say about their counter against the traditional theory. Okay, just a second. So this all things what we are discussing is about the valuation of the firm and the usage of capital structure. Traditional theory says it is relevant and says it is irrelevant, but the says it is irrelevant based upon certain assumptions. We will just look into those assumptions. Okay, that's what next. Let us read this very clearly. So proposition. So we now understood traditional theory is supporting ideal mix of debt and equity. Is not supporting. Why is not supporting, and why says the capital structure is irrelevant? On what premises and on what conditions says that? Let us see. Okay. 1958 Nobel laureates Franco Modigliani and Merton Miller, we will refer to them as published their seminal work on capital structure theory. In it, demonstrate that under certain assumptions, this is very key to this, the value of the firm is unaffected by its capital structure. What are those assumptions on based upon which says the capital structure is irrelevant against the traditional theory? This result is referred to as MM1. So this is, we will talk as MM1. So first what they have propounded, and they have not given any importance to this element, taxes. In real world, taxes are important. They say you assume that we are in a tax free world where there is no tax. Okay, in some countries of course taxes are not there. I'll not name those countries. You can, okay, fine, Dubai, but still like slowly steadily every country is going into taxes, um, and what is giving the conclusion is capital structure is irrelevant. Of course, if there is no taxes, of course capital structure is irrelevant. Okay, whether you take debt or equity doesn't matter. How? I'll give you a explanation shortly. See, debt and equity, fine. If at all, you take this, people look more into debt finance, or companies would like to go for debt finance only because debt is cheaper source of finance. Okay, first point. Secondly, you can use tax as a shield. Okay, the interest expense what you pay on debt finance, okay, can be taken as a tax shield or deduction that can reduce your tax liability and create more savings for you. Okay, and that savings can increase the value of the firm because it will save more for you. Okay, so if there is tax, the tax if there is a tax collected in a nation, and in that country your firm is operating, and your firm has arranged debt finance, it can use the debt finance to reduce the tax liabilities and save more, increases the value of the firm. But we are speaking about a country where there are no taxes. When there is no tax, then the deduction cannot be done. The interest expenses cannot be used to reduce tax liability. So in that case, if you arrange debt or if you arrange equity, what is difference in it? There is no difference, because in a world where there is no tax, debt and equity, whatever you take doesn't matter. Okay. Okay. The only thing which is, which is driving the people towards taking more debt finance is the tax, which can reduce their lot of cost and increase savings. If this is not there, then there is no difference. Then what? Then value of the firm, if you want to find out the value of the firm, like you can find out that one. If you take debt or equity, whatever it is, it doesn't matter. Okay, because the benefit is not there in both the cases. One, if there is a benefit, people take debt finance. More debt finance, less cost, increase in the value of the firm. When people cannot take this debt finance, okay, people cannot take the advantage of tax, then what? Debt and equity are indifferent. Okay, they can arrange anything, and they can try to reduce the cost. But the cost reduction here, how would they be doing? Because if they go for very high debt, again it is very risky. If they go for very high equity, again that is risky. But they can go for any kind of capital as per the because capital structure is irrelevant for the firm. Okay, so we will come to that conclusion. Need not worry. We will go ahead and conclude that. Let us understand that in more details. Okay, so in a world where there is no tax, debt or equity doesn't matter. Anything you can arrange. People go for debt only because they can claim deduction. See, now with taxes, debt is more useful. Okay, without taxes, doesn't matter, debt or equity, both are having the same kind of importance. Okay, if I tell you with taxes, debt becomes advantageous to tax shield and making capital structure relevant. However, excessive debt can lead to financial distress. So there's an optimal level of leverage. So I will give you a point here to conclude. See, without taxes, okay, capital structure is irrelevant. Whether you take debt or you take equity, both are having the same kind of importance or risk. That is, value of firm is independent. Without the depreciation, without the tax shield for interest expense, debt is also like equity only. So value of the firm is independent of debt or equity mix. Doesn't matter, whatever mix of debt and equity you have, doesn't matter, because you're not able to reduce your cost in both the cases. Okay, the cost is going to increase, and in that case, the value of the firm is going to decrease. Okay, so capital structure is irrelevant. Value of the firm is independent of debt or equity mix. You take debt, you take equity, you take whatever proportion, doesn't matter, because the advantage is not there, right? Without taxes, interest expenses can be used to reduce the taxes, and more debt there is going to reduce your WSCC. See, very high proportion of debt in a capital structure increases risk for equity holders as well. So equity holders will also demand very high returns if debt is increasing if debt is increasing more in the capital structure. If the proportion of debt is increasing more in the capital structure, that increases very high risk to the equity holders, and they'll demand more returns in that case. So that will drive the overall weighted average cost of capital upwards or increase the cost, and that will reduce the value of the firm. But in case of tax, if there is if there is a tax paid in a country, in that case you can claim interest as deduction or can reduce the taxes, and that will reduce the WSCC. Okay, because more debt you take, the cost is going to however reduce, because you are going to use the interest as a as a shield, okay, to reduce your tax liability, and that's going to increase more savings for you, and that's going to increase the value of the firm. So without taxes, capital structure is irrelevant. Whether you take equity, whether you take debt, whether you take any kind of mix of debt or equity, doesn't matter. It is because of the taxes only that is making more sense to take more debt finance when compared to equity. But again, very high debt is again a big problem. Financial distress cost is there. Okay, so I'll write the points here. With taxes, debt becomes advantageous due to the tax shield, making capital structure relevant. However, cautious. You should be more cautious. I'm speaking about optimal capital structure whereby imbalance should reduce. Okay, excessive debt, then you have to be more vigilant. Okay, don't make the debt finance to go beyond limits. So however, excessive debt can lead to financial distress. So there's an optimal level of leverage. That means you should be very cautious, or you should maintain the debt to equity ratio in proportion, proper proportion. That is basically 50-50 is good always. So I have given you the explanation in short form, but let us now understand this theory. So what are the assumptions? See, in it, demonstrate that under certain assumptions, the value of the firm is unaffected by its capital structure. Whether you take debt, whether you take equity, or any combination of debt and equity in any ways is not going to affect the value of the firm. Why? Why? Because the WACC, or the weighted average cost of capital, is not going to reduce or decrease. So if it is not going to decrease, the value of the firm is not going to increase. Okay. So the result is referred as MM1. The assumptions that lead to MM1 are as follows. The first assumption, capital markets are perfectly competitive. That is MM's assumption. Actually, capital markets are not always perfectly competitive. It is MM's assumption. So there is no transaction cost. In real world, transaction cost will be there. Taxes or bankruptcy cost. In real world, this will be there. But they say that if these all are not there, then any capital structure is okay. See, debt, you can use taxes to reduce the debt. In case of debt, tax shield, interest tax shield can reduce your liability. So that matters for you. But they are saying perfectly, like they are saying capital markets are perfectly competitive. That means there's no taxes. But taxes are there. Okay. It is based upon like their assumption. They are saying that like based upon all these assumptions only, they are saying that the value of the firm is unaffected by the capital structure. Yes, if there's no tax, debt and equity have equal importance. Why will people go for debt finance more and less for equity? Because in case of taxes, more debt can be taken and interest can be like taken as a tax shield and can be used for reducing tax liability. But when there's no taxes, there is no, like nothing like that. You can you can take debt and equity in any ways. Fine. Anything you opt, it doesn't matter. It is irrelevant. So there is no transaction cost. In this world, there is transaction cost, but they say no transaction cost or bankruptcy cost. Who says there's no bankruptcy cost? There is very high bankruptcy cost if more amount of debt is taken in the company. Very high levels of debt can create bankruptcy cost. If there's no bankruptcy cost, nothing is stopping the company to take debt finance to a very high extent. Okay. So any combination would work, doesn't matter. So the assumption what MM has is not universally acceptable, but based upon these assumptions, they try to justify that capital structure is irrelevant. Yes, they are right with their assumptions. Now, investors have homogeneous expectation. Which investor may have homogeneous expectation everywhere? Investors actually has heterogeneous expectations. Okay. Not see, we have 5 fingers in our hand, but all are not same. Okay. We may have similarities in opinions, but not exactly we would accept all the points always. Okay. We see we want to go to certain place. So there are 5 friends. We want to go there, but not always everyone would be like, ready to go only through one street. There are 5 different ways that we can reach our destination. So someone or for some other way to go there. Okay, so that is what I'm saying. Everyone will not have the homogeneous expectation, may have heterogeneous expectation, but says they have. If the people have homogeneous expectation, then what? They have the same expectation with respect to cash flows generated by the firm. If that is the case, then whatever capital structure you take doesn't matter. Because if you take high proportion of debt in the capital structure, that is going to reduce your profits with more interest cost. Okay, but they are saying that investors are having similar kind of expectation. They have the same expectation with respect to cash flows generated by the firm. So any capital structure you take doesn't matter. Okay, they are not worried about it. So there is riskless borrowing and lending. Who says there is riskless borrowing and lending? Do you think investors can borrow or lend at risk-free rate? They cannot. The lenders will charge more interest, or they will increase the cost if the risk is high in your profile. But says there is no there is riskless borrowing. If there is riskless borrowing, what is the difference between debt and equity? Nothing, right? So investors can borrow and lend at risk-free rate. It is not like that. It cannot happen. If the investors can borrow or lend at risk-free rate, they are going to get the debt finance at a very low price. Okay. Okay, so that is not going to increase the risk for the equity holders if you go for combination of debt and equity. Okay, so the value of the firm here, it is not increasing or decreasing. Why it is not increasing or decreasing? See, if more risk increases for debt finance, the equity holders will demand more returns. That is going to increase the WSEC. But here there is no risk at all. So in fact, the debt finance, you would be taking a risk-free rate, and equity holders risk is not increasing. That is there and then still. So not the cost is not increasing. So how it is going to impact the value of the firm? There is no agency cost, they say. There are no conflicts of interest between managers and shareholders. Actually, in real world, it is there. But if there is no conflict of interest between managers and shareholders, so shareholders are okay with more debt taken by the managers, because debt comes at somewhat easier and is somewhat cheaper. Okay. And investment decisions are unaffected by the financing decisions. No way. Operating income is independent of how the firm is financed. Really, operating income has nothing to do with the finance. Why? Because operating income is what? PBIT. Whatever you take, whether you take equity or you take debt, okay, PBIT is not going to get impacted anyways, because it is the income from operations. Yeah, net income is going to get impacted because of the debt finance, because we will remove the interest from this and we get net income. But this is not going to get impacted in any ways, right? So they are saying investment decisions are unaffected by financing decisions. Whatever the debt, with whatever finance you take, whether you take debt or you take equity, your operating income is going to be same. Yes. So anything you take, it doesn't matter. Okay. Now, just a second. Now, let's move forward. Intuitively, we can explain MM1 in terms of a pie. MM1 essentially concludes that the amount of pie available, there is a pie here. You have taken 40% debt, 40% equity and 60% debt. That is equal to 60% equity and 40% debt. When it is equal, they say that any combination of debt and equity you take, it is irrelevant. They are trying to explain that with the help of pi. And that is only possible because of all these assumptions. That is only possible because of all this assumption. Okay. Generally, generally, if I have to give you the reasoning, value of the firm is independent of capital structure is what MM says. Whether a firm is financed by debt or equity or mix of both, its value is going to remain unchanged. And that they are saying only based upon the assumptions what we are seeing on the board. Okay. So, but the thing is, see, I would tell you one thing. If I may say their theory is only, right, if like any of the assumptions are realistic in the world, because if the firm increases debt finance, first of all, it is going to create risk for equity holders. They will demand a very high returns, okay, due to the increased risk, and that is going to increase the cost of equity, okay. And the rise in cost of equity will, what will happen? Rise in the cost of equity will offset the benefit of cheaper debt financing. Okay, so leaving the WSCC constant. See what happens. We will discuss that also. Let's go forward. Uh, okay. Intuitively, we explain MM1. So last point, what I am saying to you will be proved in last point. Intuitively, we explain MM1 in terms of pi. MM1 essentially concludes that amount of pi available here, value of the firm, does not depend on how much it is sliced. You can see here more slice of equity, less slice, more slice of debt, less slice of equity, more slice of equity, less slice of debt. Doesn't matter. The value of the firm does not change depending on how the claims to its earnings are divided. Consider why the pi analogy holds. We will see. The operating earnings, which is PBIT, I explained you, of a firm are available to providers of capital. This PBIT belongs to the equity holders and also to the debt holders, because interest has to go to debt holders and profit has to go to equity holders. In a company with no debt, let's assume there is no debt at all this PBIT will go to whom? The equity holders. And the value of the company is discounted present value of these earnings with discount rate that depends on risk of the earnings. Okay, so what happens in a company when there is no debt finance at all the operating earnings are available to the equity shareholders, and the value of the company, if you want to calculate value of the firm, it is going to be the present value of future cash flows. And future cash flows are nothing but the revenues what you are going to generate in the future. Okay, the earnings, and you are going to discount it with the discount factor that depends on the risk or uncertainty of the earnings. That is nothing but the cost of capital. If a company is financed partly by debt and partly by equity, see first case was you are going to discount the value, discount the future earnings with cost of equity. Okay, because that is the finance you are taking. It's a all equity firm, no debt firm. So the equity, the cost of equity is a discount factor here. But if you take the debt and equity combination, the cost of capital is going to reduce because WSCC is what you have to take there. Okay, not KE, because it is all equity firm, KE can be taken. But if it is the combination of debt and equity, we have to take WSCC. What will happen? What happens is the last point will prove the MM1. If a company is financed partly by debt and partly by equity, operating earnings are divided between debt holders and equity holders. Of course, I explained it right now. If one entity purchases all the debt and all the equity of the firm, let's say there is a company A which wants to purchase this company which has debt and equity combination, and they want to take all the debt and all the equity, it would be entitled to all of the EBIT of the firm. So the total value of its holdings must equal the value of all equity firm. So what they're saying, like if one entity purchase all debt and all the equity of the firm, it would be entitled to all of the EBIT. See, if I took KE here, they are also going to get what? The PBIT. And if I am speaking about the debt and equity taken by company A, then in that case, company A also wants what? PBIT. So all equity firm also PBIT is what is the requirement, and a combination of debt and equity also PBIT is the requirement. So they are saying if one entity purchase all the debt and all the equity of the firm, it would be entitled to all the EBIT. So there also EBIT is required, here also EBIT is required. So the value of its holdings must equal the value of an all equity firm. Yes. So in both the cases, when the requirement is the same, the value of both the companies also would be same. Okay, because the claims are similar. So the value of its holdings must equal the value of all equity firm, which also has a claim to all operating earnings of the firm. So the company which is all equity is also demanding the EBIT. The company which has a combination of debt and equity now acquired by A, let's say, is also demanding EBIT. Both the companies are having the same demand under the assumption that operating earnings are unaffected by financing decisions. See, they are saying whether you take the equity or whether you take combination of debt and equity, it doesn't matter. Both the cases, in both the cases, the claim is the same, the requirement is the same. So what? So they are saying the capital structure here is irrelevant. You whether arrange all your funding through equity or you arrange all your funding through the combination of debt or equity, you only want your operating earnings, okay, or operating income. So the total value of the debt and equity will be unaffected by proportion of debt and equity in firm's capital structure. That is what they are saying. Okay. So despite of all this, what we can conclude here is MM says based upon all his assumption, he says the capital structure is irrelevant whether you take debt, whether you take equity, whether you take a combination of debt or equity. Every point of time, the claim for everyone is same. The claim is the operating income. So they are saying that whether you finance your company through any of these sources of finance, the operating earnings are always the same and it is unaffected by the financing decision. You finance in any ways, the claim is always the operating income for any kind of finances. Okay, so here we say the capital structure is irrelevant because the operating earnings are unaffected by the financing decisions. How unaffected? PBIT. This is profit before interest and tax. This is also called as operating income. Okay, I arranged my finances through equity. The equity holders want PBIT. Yes, they want their profits. Yeah, I know after reducing interest and tax, but I'm not going there. I'm not going to the extent of net income. See, MM's approach is only towards the operating earnings. They are only considering operating earnings. So equity holders want operating earnings? Yes. Debt holders want operating earnings? Yes, because interest is there in that. Debt and equity combination also want operating earnings? Yes. So when all the combination or when this and this also wants the same thing, then what? Then you go with any kind of finance, doesn't matter because everywhere the claim is the same. Okay, so the operating income is not going to get affected by the financing decision. So that is the final conclusion. Okay, just a second. So here what we can say, value of unlevered firm. Levered firm is with debt finance, unlevered is without debt finance. Okay, that's what. In any cases, the value is not going to change. So we already discussed that whether the firm is financed by either equity or debt or combination, the value of the firm is not going to get changed. Okay, because the value of the firm is independent of the capital structure. Fine, that is what they said, and we have discussed everything very clearly. The operating income is the claim for all of them. So like the same claim everyone is happening. So you take any kind of finance, it doesn't matter. Okay, because the claim is always the same. And if here they are not able to increase their earnings because of any of the finances. Yeah, that's what. So the company, if they increase their operating earnings, that is going to increase the value of the firm rather than any capital structure what they take, because PBIT is unaffected by any case, anything. See, we discussed about taxes. Okay, because of this, the people take more debt finance so that they can claim the interest expenses as tax shield and reduce tax liability. But I'm speaking about PBIT. PBIT is something which is operating income, whereby I'm not going to reduce the interest at all. So without reducing this, I'm speaking about that income which is unaffected by the debt finance if I take or if I don't take, because I'm considering PBIT only. Okay, whereby interest I'm not reducing, I'm not taking net income at all. Okay, now let's go for the second proposition. So we will discuss this also. Okay, this is the most technical chapter in capital structure, so you have to understand. So second proposition is framed in terms of firm's cost of capital rather than firm's value. So here the has given much importance to cost of capital now. So cost of equity and leverage, they are now coming to this. First case, they said you finance your company with anything, doesn't matter, because PBIT was what is the same for any kind of finances you are arranging. So everyone has the same claim. It doesn't matter. So your financing decision is not going to impact your operating earnings. Okay, your operating earning is not going to change with any kind of financing decision you take. Okay, or any kind of funds you arrange. But now they are saying cost of equity and leverage. The cost of equity would definitely increase if you increase the debt finance, because this is going to create more risk here. So now let us understand. Here the value of the firm is not given any importance, but what is given importance is cost of capital. So based on the same assumptions, MM2 states that cost of equity increases linearly as the company increases its proportion of debt financing. The cash flows promised to bondholders have priority. Yes, because the first priority is for the bondholders. They have to be given the interest first, then afterwards the equity holders will receive their remaining cash flows. And because the cash flows promised to debt holders are more certain, yes, for them it is more certain, less risky for them, then the leftover cash flows are promised to equity holders. The cost of debt will be less than cost of equity because less risk to them, right? So KD is less than KE. This is what we can understand. The greater amount of debt in the firm's capital structure, the more uncertain are the residual cash flows to equity holders. Yes, more and more debt finance, less is left over for equity holders. So tells us that as companies increase proportion of debt financing, the risk of cash flows to equity holders increases, which increases the cost of equity. So if the KD is going high, the KE will go. If the KD is going high, the KE will go more higher because more risk for them. So the conclusion of MM2 is that decrease in financing cost from using a larger proportion of low cost debt is just offset by increase in equity. So what they say is, if you people see, again they are saying capital structure is irrelevant. Don't show much importance to any kind of capital. Don't be biased. Don't always try to, give importance to debt finance or be, like more supporter or advocating more debt finance. Why? If you think that the cost of debt is very cheaper and increasing this cost of debt is going to reduce my WACC, then you are wrong. Because if you increase cost of debt, okay, which is a very cheaper source of finance when compared to equity, I understand you want to take the benefit of cheaper finance, but it is constantly increasing the risk for cost of equity. So if you want to take advantage of this, okay, this is offset by the disadvantage of the cost which is increasing for KE. So advantage, if you want to reduce your cost by 2% by taking more debt finance, your cost of equity are demanding extra 2%. So this benefit here is offset by this. So here the net result is 0. So WACC is constant here. They say that your cost, your weighted average cost of capital is unchanged, because if you want to take more advantage of cheaper debt finance, if you want to reduce your cost by 2%, let's say example, with the help of taking more cheaper debt finance, then immediately the cost of equity is going to ask you for more 2% returns for them, because they want to get compensated for higher risk what they're taking in the company because of the higher debt finance. So here reduction of 2% in case of debt finance is the addition of 2% in case of equity. So this 2% less and 2% more is going to get nullified and WACC is going to be constant. No change in WACC. We thought of WACC being going down or reducing, but it is not happening because this decrease and this increase are offsetting each other. So again, capital structure proved to be irrelevant. Okay, more of this I wanted to take. I wanted to show more importance to this. What is the benefit if you're showing more importance to this? The net benefit is WACC is not changing, and if it is constant, how the value of the firm is going to increase? if WSCC decreases, the value of the firm is going to increase. But WSCC is constant, value of the firm is not increasing or decreasing, it's constant. So conclusion of MM2 is that decrease in financing cost from using a larger proportion of low cost debt is just offset by increase in cost of equity, resulting no change in WSCC. So given MM2 that the value of the firm and therefore its WSCC is unaffected by the changes in proportion of debt financing, we can state the relation that must hold between a company's debt to equity ratio and its cost of equity. So cost of equity is nothing but the cost of debt plus the debt to equity ratio into the difference between the cost of equity and cost of debt. Okay, so that is the cost of equity. See, cost of equity is nothing but always debt finance is cheaper. Debt finance is less, when taken in limitation, it's a lower cost debt, lower cost source of finance. So if equity is 10% and debt finance should be like 6% plus the proportion of debt and equity in the company, whether it is 1:1. Okay, let's say 1 into the cost of equity with no debt, that is all equity, this cost. I'm finding the cost of equity here. So cost of equity, if there is no debt finance, let's say it is not, I'm going to find out the resultant figure. Sorry, not going to balance the equation. Just a second. Yeah, I'm going to find out this one. So 6% plus 1 into cost of equity with no debt. Let's say it is 12%, and cost of debt it is 6%. So it is going to be 12%. Okay. So as leverage, the debt to equity ratio increases. If you are increasing your leverage, if I'm going to take it 2%, if I'm going to increase the debt finance, you see the change. If I took 1, it was 12. If I take 2, 6 2s are 12, 12 plus 6, 18%. The cost of equity rises. It is increasing, yes, but the cost of debt and WSCC are unchanged. The cost of debt is the same. Only the debt to equity ratio is increasing, only that is becoming 2 here, but cost of debt is same, and the WSCC will be same, because here what happened here, like your cost of equity has to increase by how much? 6%. Okay, so the reduction in cost what you expected with more debt is compensated or is going to get nullified by the same change in cost of equity. You wanted the cost to get reduced by more debt finance, right? You took more debt 2 times than the equity, but what happened? It increased the cost of equity by 6%. Okay, but the cost of debt and WSCC are unchanged. So if this is unchanged, this relationship between the cost of equity financing and debt to equity ratio is illustrated here. See what happens. You are going on increasing your debt to equity ratio. Your WSCC is constant as you increase your cost of debt. Okay. You think that the WSCC is going to get reduced? No, the equity holders are going to ask for more, returns. Okay, for taking more risk, and this reduction what you wanted is going to get offset by this increment. Hence, the WSCC is constant. Okay, and we saw the debt finance to be constant. Only what is increasing, the proportion of debt and equity is increasing. A cost of debt is always constant. We took it as 6% there. We didn't change this at all. And the cost of all equity, we took somewhere around 12% without debt finance. And then we found out we founded the return on equity for a firm which has a combination of debt and equity. So only this was changing. Only the proportion was changing here. Okay. I increased the debt finance. Okay. And I saw what the change is. The equity holders are demanding more because I got 18%. And you can, with the help of, then you can just go for the WSCC calculation also. See, if I take up that, it will become lengthy session. So you know how to calculate WSCC with new changes. See, previously your return on equity was 12%. Okay, and your cost of debt was 6%. Then you can go for the WSCC calculation, and with this new 18% and 6%, again you can go for the calculation of WSCC. Okay, so but what is happening? the proportion of debt is increasing. And this WACC calculation, if you do here you have to take debt to equity ratio 50% debt and 50% equity. Here you have to take 100% debt and 50% 2:1, 50% equity. Then you see the changes in them. WACC will be constant. Okay, basically, let's do the calculation. Let's see what is going to happen for proving that. So okay. Combination of debt and equity. I have to just check. Of course, we got the higher cost of equity. Just a second. Cost of equity is what we got. Cost of equity with no debt. With no debt, actually, we should have a data for this. Okay. So I'm taking cost of equity with no debt. That is all equity. I took 12% and I took cost of debt 6%. Okay, previously it was 1:1 and now 2/1. Okay, 2 is 12, 12 plus 6, 18. Okay, but here I was wrong. I should have taken cost of equity. Sorry, cost of equity 12%. Okay, so just a second. We will do this calculation. Don't worry. What is that? So I'm going to take this RE is equal to R0 plus debt by equity into R0 minus RD. Okay, let's say the return on let's say 1:1 is the debt to equity ratio. We have to calculate the WACC first. Okay, with this the return on equity is, let's say, 12% plus debt to equity ratio is 1/1. Return on equity is 12% minus return on debt is 6%. So we get the return on equity with a combination of debt and equity in a company. So 18%. Okay, you just forget about that particular formula. Okay, see, that was okay, but slight mistake I have done. I am just doing it freshly. Now I'm going to find out the WACC. I got the return on equity. Now I shall be considering return on equity for WACC, weighted average cost of capital, 18% and okay, because now if I take all equity firm, that was the cost. And if I take combination of debt and equity and find out WACC, okay, let's do the WACC here. For WACC, 50% equity, so 50 into 9, 18 is 9%. 50% debt finance is how much? 63. So 12% I'll get the WACC in this case. Okay, now I'm going to take 2:1. So RE is equal to 12% plus 2 into 12 minus 6 is 6. 6 2s are 12, so 24%, right? And here 100% of this. Just a second. WACC should not change. Why? Because with more debt, the equity holders are going to demand more returns. So that is what we have taken. Debt finance is okay. So we are going to take Hmm. %. Okay, 2:1 ratio. So the debt was 50. Okay, just a second. 66%, 0.66 into 25, 0.24. 15. Okay. Okay. Getting more. WCC should not change, right? Just a second. WCC will change. Because if we increase the debt finance, the proportion of debt, the cost of debt is the same, but the proportion is changing. The WSCC, just a second. Just a second, I'm just checking this. How is this going to be? Okay, WCC unaffected. By changes. Okay. Okay. See, I will take the example here and try to look, but it will take a long time. Basically, I will prove the WSCC old one and new one. Shall I go with the example? I'll take one more example. I'll frame it just a second. Okay, let's go for this example. Let us prove, not a problem. Okay. See, we will take an example. Let's say there is a company. The total assets in the company are 10 lakhs. Okay. So current debt. Okay. I'll just take a complete example so that you'll be in a better position to understand. 2 lakhs. Okay. And the KD is 8%. Let's say. Equity is 8 lakhs. So KE is equal to 12%. Okay. I did not take the tax rate. Okay. But like, tax rate. Okay, fine. Because because here there is no restriction on taxes, right? No restriction on taxes. They did not consider taxes at all. They said cost of equity would increase. Fine. Yeah. So tax rate is 30%. Let's say. We will calculate the current WSCC. with this proportion of debt and equity. Debt here is 20% in the total capital out of 10 lakhs. Equity is 80%. So when there is a tax, after tax cost of debt, okay, let's consider the after tax cost of debt is what we will see. Like, you should take the after tax cost of debt that I have already explained you when tax is there, because the tax is taken for exemption purposes. The interest tax shield WSEC is equal to the return on equity. So 80% is the proportion and the cost of equity is 0.12. Okay, plus 0.20 debt finance into 0.08 into 1 minus 0.3070, that is 0.056. The answer would be 9.92%, 0.992. So this is the WSEC. Okay, with this combination. Now what we are discussing, we are increasing the debt finance. We are increasing the debt finance now and going to see the WSEC. Okay. See, we are going to increase the debt finance, but the cost of debt I am going to keep how much? 8% only. I'm not going to increase the cost of debt. But cost of equity is going to, change because of the high proportion of debt. Okay. So we will take the scenario 2, increase in debt finance by 4 lakhs. Okay. Now the company shifts to what? See, if I take 4 lakhs. So 2 plus 4 is 6. 6 plus 8 is 14. Okay. But just a second, I'm changing the debt finance, right, from 2 to 4. Okay, why to go? Okay, I'm not adding, I'm just changing the debt finance totally to 4 lakhs. So now 40% debt and 60% equity. Okay, I'll take that. Increase in debt, I'm scenario 2. Okay, scenario 2, I'm increasing the debt finance. So now the capital structure is 40% debt out of 10 lakhs. Okay, 40% is 4 lakhs out of 10 lakhs and 60% is equity. Okay, that is 6 lakhs upon 10 lakhs. Now, with more debt finance in the company, the cost of equity is going to increase. It's a natural fact. Why? Because debt is going to increase the risk for equity holders. Okay, so we will using MM2, the KE, new KE we are going to find. Okay. So KE or like return on equity, whatever you want, you can say. So the cost of the cost of capital. Okay. If unlevered, see what happens. WSEC unlevered means what? If there is no debt finance. Okay. So if there is no debt finance, let's say the unlevered means the firm like from which we are removing the old capital structure. Okay, and we are putting our own capital structure right now. So with that, what is going to happen? We're going to see. So RE is equal to RO plus RO minus RD. Okay. And then we will also multiply that with the debt to equity ratio that is here. So first of all, I'm not going to change the cost of debt or return on debt, or this is also called as return on debt. That is going to be 8%. That is a key factor here. That is not going to change. Okay, so RD or KD, whatever you want, is 8%. See the return on equity. So we took from the text also return on equity, like all equity without debt. Okay, return on equity without debt. Okay, because now we are removing the previous previous the capital structure was what? It was, sorry, it was, what was the previous capital structure? The debt to equity ratio was a different one. Okay, debt to equity, it was 1/4. Now the debt to equity has changed, right? It is 2/3. Am I right? So 1/4 is what? 1/4 is 0.25. Now it is 0.67. So the previous structure we are removing and putting the current structure. Okay. So your return cost of capital, if unlevered, okay, cost of capital, if you are removing the previous capital structure, okay, that is 9.92, what we calculated the WACC. WACC was the capital of the company, right? Previously. Now, debt to equity ratio is 0.67. That is 4 lakhs upon 6 lakhs. Okay. Now, return on equity we are going to find. Now you see your return on equity is going to increase. So return on debt is 0. Return on debt is like, we have just, okay, return on equity is 9.92%. So 9.92% or 0.992 you can take. 9.92% minus return on debt is how much? 8% into 0.67. This is the cost of capital if the firm is if unlevered. That means if debt finance is previously what debt combination we had, we are removing that and we are taking the new debt combination. Okay, with this the equity will increase. So your answer would be 11.33%. Okay, and you can check your with the higher proportion of debt in the company, the cost of equity has increased. Now we'll find out the WACC. WACC is 60% of debt, what you have 60% equity because 40% debt. 0.60 into 11.33% plus 0.40 into 5.6, that is 8% into 1 minus tax rate. Okay, that's going to give you 9.92%, and you can see there is no change in WACC also. Fine. Just make a note of this. So what happened here? The WACC is same here, 9.92. What we calculate? Why? Because if you increased your debt finance proportion, you wanted to take the advantage of cheaper finance. It increased the risk for equity holders, and that increased their cost by 9.9 by 11.33%. Okay, how much you wanted the cost to decrease because of more proportion of debt finance, that much the risk has increased for equity holders and demand for more return. So this has offset the benefit. Okay, since the benefit has got offset, WACC is constant. I'll write it here. WACC remains constant or same due to balancing effect of increased equity, cost of equity, let's say, offsetting the cheaper debt. Okay. Okay, please have a look through this. Then last line will conclude. Tomorrow we'll finish this chapter. See, you may be having an element of doubt in your mind. Okay, the doubt is when we did this calculation, I have already calculated the 0 point, the WSCC as 9.92. Okay, so much of the details is not there in your curriculum. Let me be very clear, but I would tell you what. WSCC was 9.92 and here I have taken the cost of capital if firm is unlevered as also 9.92, right? Is it right or wrong? Yes, Tarun, are you following? I have taken the same thing, right? WSCC only.
Sir.
Okay. See, the cost of capital is if unlevered, which is denoted by R naught, is similar to WSCC. Okay, I'll write it here. R naught is equal to WACC. The cost of capital if unlevered is similar to WACC of the firm in certain conditions. Okay, in certain conditions. Because both the return required on the firm's assets, because both, see, either, see why these two are equal in certain conditions, like because see both of this, okay, in certain conditions the like cost of capital or cost of equity without debt, okay, or cost of all equity without debt if unlevered is similar to WACC. I'll say rather than equal, I'll say similar to WACC, almost equivalent in certain conditions. This is again very big explanation, so we will go into details of that. I will just give a small explanation right now. Why they are similar in certain conditions? Because both of them represent what? Generally, in general, the return required on firm's assets. We'll go deeper into that afterwards. Okay, so right now we'll keep it short till here. Both of them represents what? Both of them represents the return on assets of the company, return on the invested money into the company. The invested money goes into what? Buying assets and using it for the manufacturing or active or whatever the relevant activities of the business. That's the reason I took that and I proved it. Now we will, that will be into that will be again continued tomorrow, not a thing I am stopping. The further explanation will be given tomorrow, but I need to conclude this theorem today and then I have to start the proposition next one. Okay, so I'm into the last line of that to prove. Okay, so MM2 is consistent with MM1. See, we have already proved that WSCC is constant. Cost of debt is constant. This is only increasing because of increasing cost of debt. That is more proportion of debt in the capital structure. If the benefits you are taking, if you want to take the benefits of lower cost debt, okay, financing, then it is offset by increased cost of equity. The proportion of debt versus equity in the firm capital structure do not affect the firm's overall cost of capital or value of the firm. So again, the conclusion part, what is the final conclusion? If you want to take the benefit of more debt finance in the capital structure, okay, by taking higher proportion of debt in the capital structure, then the benefit what you wanted because of low capital, more debt finance, higher debt finance, you wanted some benefit, you wanted the cost to decrease, okay, but that is not happening with more debt finance, okay, in debt to equity. the cost you wanted to decrease, the overall cost, okay, WSEC. But again, the equity holders, they demanded for more returns, okay, that again increase the cost, okay. So this benefit is offset here, okay. And then what is happening? WSEC is constant, and this is constant. That means what was the WSEC previously? The WSEC is the same right now. So however, it is not going to change the value of the firm. It's going to keep the value of the firm the same. So what is the use of the capital structure here? What is the need of increasing or decreasing the debt finance in the total capital structure? You increase or you don't increase, the value of the firm is going to be the same. So that proves the capital structure is irrelevant in this case also. Okay, that's what. So we will continue from here tomorrow, Tarun. We will finish this chapter tomorrow. I have a plan of finishing this, and also I am picking up some small chapter from economics that will take up. Okay, I'll inform the timing for tomorrow. Thank you.
Okay, sir.
Yeah, thank you.
Yes, sir. Bye.